Hey guys, what's up? Welcome back to another video. In this video, I'm going to be talking about a stock that could be presenting a good buying opportunity in the market right now. And that stock is Levi's. And for those of you who don't know, Levi's is essentially the apparel store that's pretty popular that mainly sells denim, jeans, and tops and apparel for men and women. And we can see that over the last year, their stock is down around 23%. In the same time period that the S&P 500 is down about 9%. So they are underperforming the market at the moment. And on top of that, over the 5-year chart, we can see that their stock right now is trading pretty much right near the IPO price that they set on March 21st of 2019 when they went public. So it could mean that they're presenting a good buying opportunity if the underlying fundamentals of the business show business growth, because that might show that the market has overreacted and that the shares could be underpriced or cheap relative to the intrinsic value per share of their company. So that's what I'm going to figure out in this video. So leave a like on this video if you want more content like this, and let's get right into it. So we can see right here from this article, they point out that Levi is down around 40% in 2022. And they also point out how when they announced their third quarter 2022 earnings results, they basically gave gloomy guidance for the rest of the year, and that although the stock is cheap, it could remain depressed by several headwinds happening in the economy right now. And so if I scroll down right here, we can see they point out that Levi basically blamed the slowdown in business on inflation and supply chain disruptions. And on top of that, if I scroll down here, they point out that Levi currently operates around 1,000 company-owned stores and 600 company-owned shop-in-shops in 38 countries. So they are spreading pretty quickly. And we can also see that they point out that Levi was one of the few brick-and-mortar apparel retailers that actually continued to open new stores throughout the pandemic. So they are continuing to grow despite the economic headwinds that happened in 2020, 2021, and that are continuing to happen right now. We can also see that in terms of regions, their brand generated 54% of their revenues in the Americas, 31% in Europe, and 15% in Asia. So they are selling to customers worldwide. And we can also see from this paragraph, they point out that the revenue growth decelerated in the first 9 months of 2022, mainly as a result of the war in Ukraine, inflation, supply chain disruptions, and the soaring dollar. So a lot of things are happening in the economy right now, and a lot of these companies are trying to adjust, and Levi is definitely no exception. We can also see right here, they point out that Levi essentially they're expecting to generate around $10 billion in revenue by fiscal year 2027. So that would equate to a compounded annual growth rate of around 9.5%, so almost 10% per year. So that would definitely provide a lot of value back to shareholders. And in terms of a quick little competitor analysis right here, they point out that Levi is doing better than some other struggling retailers like Gap and American Eagle Outfitters, but they might not be doing as well as one of their competitors, Lululemon, right here. So it'll be interesting to see where Levi goes from here based on the underlying fundamentals of their business versus their declining stock price right here. But we can also see from this article, they point out that although Levi has delivered losses of 31% to their shareholders over the last year, they have been able to grow their earnings. And so essentially right here, they point out that they managed to grow their revenue over the last year, which is a real positive. And so if the fundamental metrics, as I pointed before in their financial statements, are actually growing, then it might mean that the market has overreacted and the current decline in the share price could be a strong buying opportunity. So definitely interesting to see when a company's earnings are growing, or when their revenues are growing, but their stock price is decreasing. And so right here, we can see in these financial statements, this is their balance sheet for the third quarter of 2022. We can see that compared to November of 2021, their total assets basically stayed around the same at around $5.9 billion. And we can scroll down here and see that the majority of their business is financed by liabilities as opposed to equity. They have around $4 billion in total liabilities and around $1.8 billion in total stockholders' equity. And the retained earnings line item has increased right here from $1.4 billion to 1.6 billion over the period. So their business is growing, and this is obviously a line item that shows that they're going to have more cash to reinvest into the company or distribute to shareholders. But on top of that, their additional paid-in capital also increased from around 584 million to 609 million. And that can sometimes be a bad sign, because if they're issuing new shares and taking on new partners in order to raise capital, it's going to dilute shareholders and reduce the price of their stock. So could be a bad sign because of their additional paid-in capital, but also a good sign because of the growing business and their retained earnings line item. And so right here, if I go to page 5, we can see their income statement for the third quarter of 2022 compared to 2021. Net revenues during that time period increased around 1% from around 1.49 billion to 1.51 billion. Their gross profit also increased slightly from around 862 million to almost 863 million. But during this time period, their cost of goods sold actually increased as a ratio to the revenues, because their gross profit margin for 2022 was around 56.9%, but it was down from 57.6% in the prior year. So although their revenues increased, their cost of goods sold increased faster than the revenues did, mainly, as we saw from those articles from before, as a result of the war in Ukraine, inflation, and other economic headwinds. Then lastly, right here in their line item, we can see net income is down around from 193 million to 172 million dollars. So that's a decrease of around 11% year over year. So although their revenues have increased, their costs of goods sold and their costs of operating their business have increased pretty substantially. And so as a result, their net income has actually decreased during that time period. Lastly, for the financial statement analysis, we can see this is their cash flow statement comparing the 9 months ended August 2022 to August 2021. And during that time period, we can see net cash from operating activities decreased from around 500 million to 210 million dollars. And then we can also see in their financing activities, they repurchased common stock equating to around 140 million dollars and paid out dividends to stockholders of around 127 million dollars in the first 9 months of 2022. And so, interestingly enough, if we look closer into the repurchase of common stock item, I know it doesn't say here, but I got this information from another source that they provided. They pointed out that they repurchased around $26 million worth of shares in the third quarter. And then for their dividends, they paid out around $48 million worth of dividends in the quarter. And their dividend per share was up around 50% year over year to 12 cents per share. So they are prioritizing returning value back to shareholders at the moment. And so right here, this is the intrinsic value analysis, a discounted cash flow model that I prepared to try to figure out the intrinsic value per share for Levi. Yahoo Finance is estimating that this company is going to grow at around 9.3% compounded annually over the next 5 years. So I was conservative and I cut that value in half to 4% for the next 5 years after that. They had around $576 million worth of free cash flow in the full year of 2021. They currently have a net debt position of around $1.5 billion after subtracting the cash on their balance sheet, and they had around 96 million shares outstanding at the moment. And so with these metrics in mind, their intrinsic value per share is estimated to be around $73 per share, with a 50% margin of safety of $36 per share, which means compared to their current share price, it means that Levi could be trading at a really steep buying opportunity right now, since they're trading only at around $18 per share. And yet, according to this discounted cash flow model, a 50% margin of safety relative to their intrinsic value per share comes out to be around $36 per share. So that is definitely a very steep discount relative to their current intrinsic value if they are able to maintain these growth rates of around 4 to 10% over the next decade or so. And so to end off the video, I wanted to compare them to some of their competitors in terms of a financial ratio analysis perspective. We can see I'm comparing them to Gap and Fitch Company, and we can see compared to those two companies, their gross profit margin comes almost tying with Fitch Company right here at around 57 to 58%, definitely beating out Gap. Net profit margin, Levi is ahead of the pack at around 9.6% compared to the 1 and 7% for their competitors. They have the highest return on assets at almost 10%. Their PE ratio is the lowest, which could be a good sign, because obviously that means that they're not priced at a really expensive stock price relative to their current earnings. Whereas with Gap, and Fitch Company, they're trading at a PE ratio of around 50 and 80 times earnings. Levi's is only 11 times earnings, so that could be also a good sign. And then lastly, for dividends per share, we can see that Levi currently has the second highest dividend per share at around 26 cents per share compared to Gap's 60 cents per share, and then Fitch Company, which didn't really pay a dividend in 2021. So in terms of a competitor analysis perspective, it looks like Levi, generally speaking, is ahead of Gap and Fitch Company. So we'll have to continue comparing them to some other competitors to see where they stand in that regard. But Levi is definitely trading at a very steep buying opportunity. So it'll be interesting to see where this company goes from here. But I'd love to know what everyone watching this video thinks about Levi. Is it a good buying opportunity at the current share price? Let me know what your thoughts are in the comment section down below. Leave a like on this video, subscribe to the channel, and I'll see everyone in the next one.